How to beat institutional traders. Now, if you've been trading for a while, you at some point or another would have probably had the idea in your head of, oh, if I could just trade with the smart money, if I could just trade with the institutional traders, then I will finally have the best edge that I can get. And ironically, that belief is actually completely false. It's not just false, it's actually almost the opposite of that that provides the biggest edge. And so I'm going to give you three major reasons why this is. But first of all, this is part 4 in a 4-part video series here on YouTube. So if you haven't seen the previous 3, I would recommend watching those. I'll leave links for those in the description box below, and then coming back to this. But if you don't want to do that, it's fine. This video will still be actionable for you anyway. So anyway, the 3 big reasons why you don't really want to be trading just with the institutional traders in the way that most people speak about it. The first reason is that institutional traders are not incentivized to take risk. They're humans. They don't want to look like idiots in front of their peers and their friends and their community. Why is this important? Well, because they don't want to be the person that's standing out there going against what the kind of overall narrative, that the mainstream narrative is, because if they're wrong, they're going to look like an idiot. That's a very human thing. We all have that, and these people are no different. If anything, it's worse with them because they have more on the line. They have their jobs, they have their reputation. They might not get hired if they make a mistake or on the media, and then it comes out later. These are slight exaggerations, but hopefully you see the point. Second reason is institutions are not trading the same way as you. Right? This is so important to understand because we think that, oh, if I can just follow where their money is going, it's like most of them are managing portfolios. That is extremely different to what I'm assuming you are doing as a trader as compared to what I do, for example. I typically am looking at a kind of 1 month to maybe a 2-year time horizon of predicting certain markets. That's it. Normally it's much shorter. Normally it's like 1 to 3, maybe 6 months. That's the majority of what I do, right? So that is extremely different to someone who's allocating different amounts of capital in a portfolio to essentially manage risk. Because these portfolios, yes, they're there to make money, but it's a completely different game to trying to time the market, which is essentially what we're trying to do. And so by trying to combine these things and go, oh, let me trade with that money, it gives no weight to why they are moving money, how they are moving money, and in the context of what strategy. And so trying to copy them can actually create, ironically, one of the worst performances that you could possibly ask for, because you are trying to combine things that are inherently totally different. Anyway, number 3 is these institutions getting trades passed through. There's normally a lot of bureaucracy that comes with that, meaning it takes time for things to move. Like, for example, if they see a certain trend happening, things going, they have to go through a lot more hoops to get trades finalized, passed, especially because of the volume and the size of their positions. And so it takes time for them to jump on the bandwagon, by which point a lot of the move has already happened. Yes, they can extend the move, and yes, they normally still do get in kind of a little bit earlier than some. There are ways to get in before them. We actually have advantages over them because of that bureaucracy, because of how slow that they tend to be. And so this is really important because it means that, okay, what's the thing that's maybe going to allow us to catch on quicker than them? Is it going to be looking at the same, numbers and company earnings or macroeconomic statistics that everybody else is looking at? Or is it going to come from something a little bit more nuanced than that? And it is more nuanced than that. And the big case that I've been making in this video series is about narrative. If you're just a technical trader, or that's what you've been historically, or you're just a fundamentals trader, you'll find that with a lot of these things, especially if you're trying to do these short term meaning in my eyes under 2 years, then you are going to really struggle because sometimes things change. Things change actually a surprising amount of the time. And so you'll be left going, well, I don't understand, why did something change there? If you're just looking at one, not looking at the other. And understanding how to map these things is really what this whole video series has been about. And so in terms of narrative, which is the missing link between technicals and fundamentals, there are main phases that tend to happen. At first, we have reality. Then we have the early adopters, the first ones to catch on to what's going on. Then we have the media suddenly giving it attention after some of the move has happened. And as the media goes, obviously more attention goes there. And eventually we move into the next phase, which is retail. So this is where retail traders, everyday people like you and me, suddenly start pushing in more and more capital to the market, where your trend traders are typically going to come in. And then finally, we get to the exhaustion phase. Now, unsurprisingly, this is where most of the information is agreed upon. Everyone already knows. And whilst everyone's still excited to continue trading that trend, the value has already been priced into the market. And so therefore, it's kind of useless at that point. Now, what's really important is being able to map this. Because if we can map this, if we can find ways that we can spot things earlier than other people, then that is the basis to have a better edge. Getting there first is really the biggest edge you can get in trading. As I discussed in another video that I made on my channel, the first video I made, insider trading is illegal because it gives you an unfair advantage. And whilst we are not trying to do anything illegal, the fact that it's unfair gives you a hint as to what the biggest edge possible can come from. Doesn't mean we should insider trade. It means we should take the premise of what makes an insider trade work, which is knowing really important information before everybody else and then trading on it. The fact that that produces such a large edge that they had to make it illegal because it's so unfair means that if we can do the same premise but without breaking the law, then that's where the biggest edge is going to come from, right? So I've got three main examples that I want to go through. I've got one individual company example, one crypto example, and then one macroeconomic, in other words, a broader example. So let's start off with the company example. So I've gone with a very classic one, which is Nvidia. So this was between 2022, 2024. It's this initial cycle that we are mapping. And I'm going to map it in terms of the phases that I just walked through. So if we go over here, zoom right on in. This first phase down here, not much movement. Yes, we'd already had kind of movement in the past and gone through another cycle, but at this point we had the reality setting in. So this was that AI needs a lot more computer power. This is just at the fact stage. There were some very, very early adopters, and these zones are never going to be exactly perfect. But around this time, people started, very, very few people who kind of really knew about what they were talking about did notice that AI was going to need a lot more computing power. And the big fear here was that we're going to miss the next big platform, right? So what most believed is that it's interesting, but earnings won't change very soon, right? This is a very common thing at this stage because especially with an individual company, it's like, oh yeah, like I get it, this probably makes sense. But at this stage, it doesn't really seem like big enough. It doesn't seem like the difference is going to be, just put that on me a little bit more. It doesn't seem like it's going to be as big of a thing at this stage for it to be worthwhile. So that's that little stage here. Then we move into the next stage, which is the early adopters stage. Now to zoom in a little bit so you can see. The early adopter stage, this was about March to May 2023. The story forming at this point was sell the picks and shovels, which are the chips and the power, because a lot of these AI companies were not publicly traded, or if they were kind of owned by kind of much larger companies and it wouldn't have moved the needle much. The idea here is instead of directly betting on AI, you bet on the things that AI is built off of. It's kind of like a second order consequence, meaning it's not the direct thing you're betting on, it's a layer below that for something that is required to make that first layer function. So the core fear here was that it was under-owned winners. So all this is really saying is that it's going to be a fear amongst the early adopters that, okay, these winners aren't they're gonna move up so quickly. We are scared about being late. This is quite common with an early adopters theme, right? They are normally scared about being late, which is understandable because by definition, they're early adopters. And really, just FYI, in the ideal world, we'd be kind of as close to understanding it, at least in these two sections as possible. But the best thing is that you don't even necessarily need to do that because it's more about understanding when the narrative actually shifts. And again, the last three videos are going to be really helpful understanding what I mean by this, but really it's more about timing the narrative than just understanding it. You really need both. So again, what most believed, this is again a really common thing, show me the numbers first. This is another example of institutions, they need numbers to make decisions, right? And it's very difficult for them because they're following models to forecast things that are non-linear. Meaning if it doesn't just kind of grow with like a kind of projected growth rate, if you look at, for example, the growth of an industry, the way that I never can pronounce this word without stumbling, statisticians, so people that study statistics, these people, when they're projecting the growth of an industry, you'll notice that even if it does grow up, it's done by very fixed percentages. As soon as you get like that variable, non-linear, exponential, where it's kind of varying, it's very difficult for models to actually do that. And so why is this important? Well, because this is another reason why institutions are slower than you. If you can understand the narrative and make basic predictions that maths takes time to catch up on, that lag, known as narrative lag, is one of the biggest reasons where big edges can come from. So the reality here is that big tech raised spending plans and the orders were locked in. This was really important because it showed that, wow, okay, money is being pumped into these companies at this time, and yet people are still not paying as much attention as they could. You can even see in prices, like towards the end, we did start seeing some uprising. Now, compared to obviously all of this, it's not going to look like a big uprising, but you've got to compare it to what was available at the time. And you'll notice that we breached all-time highs with this candle right here. That's significant at the time because you would have only been able to see this at that point, right? That's very, very significant. So what does this mean? The signals is that Nvidia's blowout guidance, more AI on earnings calls. So that's just a fancy way of saying that Nvidia is going to smash earnings, basically. So next stage, the media stage. So ironically, in this stage, we kind of got a bit of consolidation. This can actually happen quite frequently around all-time highs, but that's a topic for another video. The idea here, the story that was forming, is that AI changes everything. So this is, if you remember, goes back to the time when all the media outlets were being like, oh, AI is going to change the world. This is going to go crazy. And it may seem like something that we take for granted now because AI is everywhere in the news all the time. However, at this point, AI wasn't like crazy in our faces like it is now. And so you've got to think about, like, whilst it's obvious now, everything is obvious in hindsight. And at the time, it would have taken real research and real effort to understand the AI narrative and understand, oh, wow, this is going to be a big thing in order to have actually understood this. If you're just sitting back going, yeah, I could have spotted that. That's great, but could you actually have spotted it? Like, there are things happening today where you probably aren't even aware of them, but as soon as they become popular, it'll be like, oh yeah, this was obviously going to happen. The difference between someone that is good and bad at an informational style of trading is somebody who actually puts in the work to understand what these big things are before they happen. That is the job, which is also the purpose of this channel, by the way. So hopefully it helps. Anyway, the core fear of obsolescence. God, I can never pronounce that. Obsolescence. What most believed? Broad excitement. Naturally, any game-changing story, especially one as big as AI, people are going to start getting very excited about it. Reality is that attention itself pushed price. Fundamentals were catching up more slowly. So again, the numbers are lagging behind the attention and the belief. This is a common theme with narratives you'll see over and over again. Signals, AI headlines, Google Trend searches peaked, AI ETFs took in money. Now, we move into the big phase now, which is in this case, the retail/euphoria stage. The story forming here is that AI, everything is going to be AI, forever up. This is a classic kind of retail narrative because retail tends to die on certain kind of hills and be like, oh my God, this is going to be great forever. This is such a huge narrative. No one gets it. People basically starting to get very, very overexcited about everything. And the core fear here is FOMO. You will see that FOMO is one of the biggest drivers in this case. As more and more attention comes over it, it's going to be really big. Now, one thing to mention is that these cycles, whilst I've put them as separate, they tend to compound on each other. So the media cycle isn't just set to here. As prices go up even further, more and more media coverage comes out, which just creates this exponential growth. So it's a blend of all of these things together that really creates things to go up exponentially, as we've seen here. So what most believed, so at this stage, most believed crowd piled into a few leaders. So again, people are tending to concentrate at this point into the big players, such as Nvidia in this case. The reality is that attention growth slowed and leadership narrowed. And the signals were that big post-earnings day went flat, retail call buying surged, okay? So fairly self-explanatory. The kind of big takeaway from this is more so that retail getting involved, more media attention compounding because of how the markets were actually moving led to this meteoric rise. However, as we get to the exhaustion phase, The story forming was that costs are high, the power grid is tight, and payback takes time. This will naturally happen after something's been going up for a while. People eventually become more rational. Normally not the retail traders first, but people tend to become more rational, and they start looking for the flaws that maybe they dismissed more in the beginning. And in this case, the cost of running these machines, the cost of manufacturing them, these things were actually beginning to take effect. Now, the core fear here was that there'll be a profit delay. And so what most people believe was a split camp. So the believers versus doubters. So this is important because this is where stories began to conflict. When there are stories that conflict, even if the overall stock ends up going up, which it did in this case, it creates this kind of uncertainty. And if you look at it just from a pure price perspective, when we came out here, so around this line, if we were to draw this on, so around this line of price, you will notice that we are fluctuating around that. Yes, it's easy to get lost and be like, oh, we went down and then we went up and then we went down. Yes, but we're still kind of averaging around that main price. And that's why it's really important to understand. And so the exhaustion unwind, reality, story speed cooled, money rotated to power/equipment plays. And the signals were that more headlines were on power constraints and margin worry chatter. So again, this is an example of it not always being about you being the first. It's about when the narrative changes in your favor. It's about understanding, okay, now is the time that things are aligning with what I already believed. I've already done my homework. Now's the time to size up or size down. The big thing that people get wrong with narratives is they think that, oh, it's just about spotting the narrative. It's about being first, or it's about just knowing that the wave is there and that's it. But that's not the case. You need to have a good, strong understanding of what's going on with the narrative, but you also need to understand when it's changing, because when it's changing, things need to align with you in order to work. I could be right here. I could be right. Sorry, I know you can't see it. I know you can't see the full of me, but if you are here, for example, right? If you're here, you could be right that a stock is going to go up within 2 years, for example. But in the meantime, it could go down and then go up in the last 3 months, for example. And so just by you being first doesn't mean anything. The timing layer is important. How do you time? It's about understanding the story arc and knowing when things are shifting in your favor. And just that alone isn't enough either, because you also need to understand that the edge isn't just from waiting for narrative to flip in your favor, because then why wouldn't you just wait for the narrative to flip and follow the narrative? Because it's about sizing. You take the bet, not you, this is not financial advice. I'm just saying that the best informational traders, because they have done their homework, because they know the consensus is aligning with what they've already researched, at that point, they feel more comfortable adding more size to their positions because they are more confident. And that's where they know the biggest edge is, assuming they have real conviction. That is the difference. That is the edge. So anyway, after that, you can see we consolidated, then we ended up going up. Remember, there are normally cycles upon cycles, and I'll show you an example of that in a minute. But you need to understand that there are always new stories coming out. There's always new information. So, and also a lot of these things are crossing over and lots of stories on top of each other. It's more so just about understanding what the dominant one or two fears and what the one or two dominant stories are, and then trying to capitalize on those. Next example is Bitcoin, classic example. So Bitcoin 2020 to 2021. This is a very, very clear and obvious example to look at. If you guys were still trading around then, you'll probably remember this. I remember I was getting very excited, and I definitely was pretty late to this. I remember specifically for me, I started kind of understanding that crypto was going up right around here. And I, at the time, was, it was a great couple of months. Anyway, let's go to the case. So the reality, again, these boxes, I just want to stress, are not like this is exactly the time period this happened. They're rough areas of time where these things happened. Like, for example, the reality here, I've put the story forming is that the digital hedge plus money printing, supply cut, halving is coming. So all this is basically saying is that the story that any early kind of any early adopter or someone would have had is basically the argument for Bitcoin. They understood what the argument was, essentially that it was a hedge against the dollar, which was projected, and people were losing faith in it, but projected to go down. And the core fear was that they're missing protection in a crisis. It was that they're going to lose money by keeping their money in dollars. And so by definition, people naturally look to put their money into safer things or things they believe in more and more and more. And Bitcoin was one of these things for people that were early here. What most believed, still too risky after the 2018 bear crash hangover. So after we had that bear market in 2018, because prices were higher before here, this was a natural thing. It was a natural fear. People were uncertain. This is just very common with just how market psychology tends to work anyway. People get very scared when things go down. The excitement for something goes down. If it's in a bear market, if it's going down, the people are like, oh, this is kind of boring now. But ironically, a lot of the times, not all the time, assuming the underlying asset is good, that can actually be one of the best signs. Anyway, what was really happening? So massive money creation, plus Bitcoin's new coin supply was about to be cut. So if you don't know, Bitcoin tends to cut its supply. And so this is very, very important because ultimately it's just basic supply and demand. If you've got something that people believe in the value of and you halve the supply, that means that the demand is going to go up. And if demand goes up, that's another way of saying the price of it goes up. For example, if you take all the gold right now, whatever the price of gold is right now, and then someone magically snap their fingers and half of all of the gold in the world disappeared, that would make the gold that remained probably about twice as valuable. It's the same concept. So simple signals, March 2020, QE, which stands for quantitative easing, surged, which basically means printing money. And then on May 11th, 2020, the halving was set, which were coins were moving off exchanges. Again, supply is being cut. Early adopters, story forming, post-halving, supply squeeze, smart money is nibbling, core fear, underexposed if the new cycle starts, what most believed, skeptical, COVID uncertainty, reality, accumulation is building, meaning people are just building their positions, first visible institutions showing up. So this is important because institutions showing up, as I said earlier, they can often be slow, and first visible institutions showing up. The smaller institutions typically are allowed to move quicker than the larger ones. This is for many reasons, just bigger organizations in general tend to be more bureaucratic. It's why larger companies take longer to adapt to new changes than brand new, small, really competitive startups or just smaller companies. But it's also because they have less money, the smaller ones, the smaller institutions than the larger ones. And so they don't need to jump through as many hoops, check as many things. Maybe they can take a little bit more risk. There's less rules, there's less kind of governance within the company. There's lots of things that it can be. But it's important because it's not that institutions are never wrong. This is the key thing. Just because you're trying, what I said at the beginning, doesn't mean that institutions are wrong. It just means that you need to understand your own narrative beforehand and then use the institutional as a confluence layer on top. Signals here, exchange balances trending down, on-chain holding grows. MicroStrategy announces the Bitcoin purchase. MicroStrategy is a huge company, and Grayscale inflows rise. So even if you don't understand what most of those words mean, the key thing to understand is that at this point, what we're just seeing is evidence that anyone could have spotted, me, you, anyone, if we'd just been paying attention and put the pieces of the puzzle together and been in Bitcoin at a much earlier point if we began seeing things aligning in our favor. And here, this is an example, first visible signs of institutions showing up, these sorts of things. It would have started coming out in the media kind of shortly after. These are kind of signs that consensus is shifting with what you're doing. And it basically allows you to avoid a lot of the bear market and just get in with the bull market. Now, don't get me wrong, doesn't mean you're going to time things perfectly every time. And this is just a kind of very basic overview, but it gives you an idea as to really understanding the value of narratives and looking at the market through this frame. Because in a way, narrative is like fundamentals and technicals and story all had a baby. Like narratives are basically all of those things kind of put together, maybe less technical. Anyway, the media. So during this phase, we can see we had a big, sharp rise. And then during this period, September to December 2020, the story forming here was that the mainstream on-ramp arrives. Missing the turn to adoption was the core fear. Again, FOMO is essentially another way of saying this. What most people believed, growing bullishness as big brands touch Bitcoin. Self-explanatory. Reality, attention jumps, headlines cluster. Classic media phase, obviously. Signals, Square buys Bitcoin. PayPal enables crypto. Bitcoin breaks the 2017 high, $20,000. Google searches climb. These are tangible things that anybody could have spotted. And again, I'm going to stress the point again. It's very easy to look at this stuff in hindsight and be like, I could have seen that, no problem. Oh, wow, this is really that easy. No, because you really need to be paying attention. You need the whole idea of this is it requires understanding risk. It requires understanding really having done your homework beforehand, not just copying what someone on the internet, myself included, does. Anyway, next stage, retail euphoria. You can see just how vertical this is getting towards the end of the media phase. You could argue that retail started a lot sooner here, but retail, I remember personally from getting in around here as a kind of retail trader when I was a lot less experienced than I am now. I remember the hype. Everyone was talking about it positively. Everyone was kind of going, wow, there's so much money to be made. It just felt like, a complete gold rush. And this is a classic symptom, it's the old Warren Buffett saying, which is be fearful when everyone else is greedy and be greedy when everyone else is fearful. It's the same concept just applied to a smaller time horizon in this case. So here the story forming, again, this is just normal retail that, okay, we're going to be going up forever. The core fear is that they have a fear of missing out. Most people believe at this point that it's a one-way trade, at least in the short term. And even if they knew in their heart that it can't go up forever, there is a psychological urge in people to only really be looking in the very near term. And in the very near term, most people believe that it was just kind of going up. People were going, oh, it's going to reach 500,000. It's going to reach this, going to reach that, pumping out all these big numbers. And the reality is that the more you see that, often it's a sign that things are probably going to be slowing down a little bit. The reality, though, is that leverage and retail activity surged and mania broadened to alts. So if you don't know what alts are, this is like the kind of smaller cryptos underneath Bitcoin that you're going to see a lot of. And the smaller you go, the kind of more volatile they'll go. And this is what I did. I was investing in like crypto gaming coins around here, and they were just moving violently. I was doing like 10% a day, sometimes more. It was just crazy times. But that I ended up giving all that back crypto when this happened because I wasn't as versed as I am now. Anyway, signals at this point where the exchange/app signups spiked. So this is an example of alternative data that anyone could have seen, right? Yes, it's slightly lagging and it's kind of not a perfect indicator, but it's pretty good. Viral crypto content, the rise of crypto channels, Tesla buying it, Bitcoin at an all-time high, and also the coin IPO day. So don't worry if you don't know what all of those things mean. The main thing that I'm trying to get across here is just the importance of narratives and understanding exactly what to look for and the kind of characteristics of each stage. So the exhaustion/unwind stage from May to July 2021, the story at this point was environmental concerns, China crackdown, forced selling. There were lots of other things, but it was essentially a converging story about people doing exactly what happened with the previous example with Nvidia. It's not that the underlying asset loses its value. It's that humans using reflexivity, which is again something I talked about in one of the last videos in this series, price detaches from the fundamentals temporarily because of how humans are. The more something goes up, the more attention it gets. The more attention it gets, the more it goes up. And the more it goes up, the more money goes in, which makes it go up even further. And so you get this exponential climb. Then people start going, whoa, hold on a second. This is starting to look a little bit like a bubble. In other words, something that is kind of massively overinflated, and we need to bring it back down to reality. And it's not like there's one person clicking a button going, right, bang, let's bring it back down. It's that capital is flowing out of it because of this risk assessment. They're looking at it going, okay, this is kind of getting a little bit risky now. I've already had a big move. Like, let's just kind of chill out a little bit. This is looking like a big bubble. And retail are normally the last people to figure that out. So the core fear here is that liquidation/ban risk. What most believed, sharp flip negative. Reality, a reflexive unwind as leverage is flushed. Signals, May 12, 2021, energy tweet. May 19th, crash, China mining shutdown, hash rate drops, cascading liquidations. So again, it's just more about how the story shifted. If you look at how the story was in the media, it was like everything was being positive. By the time we got to the retail phase, it was like, oh, things are just going up, it's going great. And it's all about just understanding essentially mass psychology, understanding how to spot the signs of people going a little bit crazy and getting greedy or getting fearful. And when the balance starts shifting, that's the point to either get in or get out, depending on which stage of this cycle that you are in. Now, of course, Just that on its own is not enough. You need to actually have a reason for why you believe in something, and then you're waiting for this layer, this narrative layer on top, to align or disalign with what you have predicted. It's not just about, oh, I can see what's going on with the trend. It's like, okay, but do I understand the underlying thing that this narrative is basically communicating me with? So narratives are essentially like a timing layer. That is the way that I use them for entries, the way that I use them for exits, but it's also something that allows for conviction, which is huge, because if you were just trading a technical strategy throughout this period, right, you would have probably done pretty well, buying, amazing, amazing. You're like, oh, this is incredible. But you've got to think about the emotional state that you'd be in here. You'd be very, very confident because you've just been off, been winning. When things start going against you, you're going to be like, oh God, yeah, this is great. It's just a deeper pullback. I'm going to buy. I'm going to keep my position sizing up, maybe even increase it. But then what happens? You just liquidate yourself. Everything just goes back and you're like, oh God, damn, and then you're back at square one. This is what most people do. And then at this point, what happens? People are like, oh, screw Bitcoin, it was fun while it lasted, it's not exciting anymore, I'm not really paying attention. And then just as that happens, another run happens, and the same cycle goes on in different forms or another. There's always cycles within cycles and all this sorts of thing. But as long as you understand the macro of what's going on, that's a really, really good indication and a good thing that I think a lot of people miss. So the final example is a little bit broader. So this is the macroeconomic example. I left this last because I know some people probably aren't as interested about kind of the broader economy. It's not as sexy as everything else. But for those of you that are actually interested in how the world works, this hopefully will be an interesting example for you. So this is another reason I left this last, is because there's two overlapping cycles and they're intertwined and interrelated. But I wanted to map two of the main ones on top of each other so that you could see how they often influence prices. So first of all, I'm going to start with the bottom ones. So the bottom ones start here, all these ones on the bottom, and then so starting here and then ending on this lower red one here, and then the top ones start here and then end on this upper red one here. So just take a visual bird's eye view of what this chart looks like, kind of a flat. This is the US 2-year Treasury yield, which often correlates a lot with interest rates. And so if you don't kind of understand the basics of what an interest rate is, during this particular period, the main fear was inflation. Now, why is that important? Well, because as inflation rises, the main tool that a central bank, in this case, the Federal Reserve in the US, what they will do to combat that is high interest rates. Basically, they will increase the cost of borrowing money. As that happens, the idea is that over kind of, I think it's about 18 months or sometimes even a little bit longer, the economy should then, specifically inflation, should eventually decrease. And then it's this constant balancing act. But that's the kind of main idea of interest rates, in this case, using it to combat inflation. So let's look at the stages. So in this early stage, prices look flat, but if you're looking at it, it would look more like a consolidation. Everything always just looks super flat when you're looking in hindsight compared to the big move. If you were really zoomed in on this, it probably would look a bit flat, but not maybe as flat. So the story here, inflation's temporary. Don't worry about it. It's not that big of a deal. The core fear is that, don't overreact, don't look stupid. It's everyone's saying this, but it's not crazy. Don't worry about it. In other words, most people are believing that it's transitory because the Fed said so. Now, the Federal Reserve, they will give you clues as to what they're saying and what they're thinking a lot of the time ahead of time. So they'll be like, oh, we're seeing this, we're scared of this, or we might do this in the next few months or in the next year or something, or whatever it is. And so often, because people are just listening to the narratives that they're told, they will often piggyback on it. Whereas if you could be right about something before everybody else, that is going to be really useful. Now, an important caveat that I want to make here is you're going to be better at finding these nuances and predicting these nuances. And by the way, I'm going to make a whole other video series just on actually finding these and how to observe them, how to validate them in a separate thing. This is more about narrative. But the better you get at actually understanding what's going on and specializing ideally in one particular area, the better you are going to be at spotting things when they show up. For example, if you are someone who specializes in just a few individual companies, you are going to have a much better idea of what the narrative is and how it changes and what the opinions are and what the beliefs are over time than someone who's monitoring 100 companies versus someone who really understands the macroeconomics, so how money flows in and out of things like the bond market, the gold market, the equities, in other words, the S&P 500 stocks in the US or whatever. These are kind of bigger flows of money, and everyone specializes in their own thing. But understanding whichever one you pick, whichever one interests you the most, that's going to be really important, because it's the thing that's going to allow you to make or to spot the best things that are about to happen. And some of them are easier than others, and some of them are harder, which again is the topic for another video. Anyway, so what was really happening at this time? So costs were rising everywhere and sticking. So inflation, one of the key measures of inflation is how expensive everything is getting. You probably remember this in the last kind of few years, everything has gone up. Like the cost of living has gone up massively, the cost of living crisis. What this is this is the very, very early stages. It's if you paid attention to this before it got to the media stage, which most people, if you're watching this, you probably became aware of it. Yes, like every day, like things are getting a bit more expensive, but you probably didn't really notice it until the news station that you watch or the social media channels that you follow started talking about it more and more and more. And again, in hindsight, it looks like, yeah, obviously I could have seen that. But could you? Can you tell me right now what's going on in terms of inflation just off the top of your head? Can you tell me right now what's going on, or if you're not interested in macroeconomics, what the narrative of a particular company is and where that's projected to go and why it is? If you can't do that, then it's very easy to look in hindsight and be like, yeah, would have worked. But unless you can do that about something, then you can't expect to ever catch that ahead of time. Catching it ahead of time, as I've said multiple times now, is about really understanding what you were looking at and then using the narrative layer on top to see how that develops over time, and essentially as a risk gauge of getting in, getting out. Anyway, as we moved into the second stage, we saw a little increase. Again, this looks tiny in the grand scheme of things, but if we compare it back to the previous however many months this is, that is significant. So what happened here? Again, this is the early adopters phase. So the story forming here is that this is bigger than a blip. You know, inflation is still rising and we're worried. And the core fear here is that we were falling behind rising prices. And what most people believe, they believe, look, yes, this is going up, but you can go back and look at the media articles on this at the time, because they were still, for the most part, going, yeah, like it's still going to recover, it's going to bounce back, you know, it's going to come back down again. This sort of thing has happened in the past and we'll be fine. But the reality is that there were shortages, wages pushed prices higher for longer. So the signals here, commodity indexes up and more companies saying inflation. These are subtle signs, there are way more signals than this, but again, it's just to give you an idea. Then the media starts talking about it. We see this big rise approaching here. So the story forming is that inflation is back, right? This is where, again, the fears start riding up, and the core fear is runaway inflation. In other words, inflation that just keeps going up and up and up and we just lose control. There are even people talking about like hyperinflation coming back at this time. They're like, oh my God, what if it doesn't stop? You'll notice that with a lot of these things, narratives are inherently emotional. Humans get scared. We all get scared. And so this constant cycle between fear and greed is really what we are getting better at measuring here. It's the only thing I really care about looking at this stage. It's all about understanding emotions of the herd, of the masses, and basically knowing when they're wrong and when they're right, and then aligning myself with that. That's the whole premise of what I'm doing. Anyway, so what most people believed, they flip to alarm, they start shitting themselves. And basically, reality, attention finally caught up with the months-old data. Months old. That means there's months, where there's a lag between understanding what's going on and actually the market catching up with you. That in and of itself is area for an edge if you know what you're doing. And that's a big if, because being able to predict things is important. And I'll also leave the link in the description box below for the next video, which will talk about prediction. Anyway, signals, headline spike, short-term interest rates jump. Self-explanatory. So if you don't know what this is, as I said, interest rates are just used to essentially combat inflation. The central bank will increase the cost of borrowing, and they'll also give insights into how quickly they're looking to do it or how slowly. So if it is looking to aggressively raise interest rates and talks about that a lot, it will be considered more hawkish. Or if it's looking to aggressively cut interest rates, it will be considered more dovish. Essentially, just think of it as bullish and bearish, but just with like the tonality of what they're saying. Then we move into this next phase, which is the retail/euphoria phase. Everything is pretty clear at this point. Everyone's shitting it and everyone's like, oh, wow, interest rates are going up. And therefore, you know, in this case, this market is likely to go up. And by the way, this whole move accounted for, I believe, about 1,100% up to about here, which is pretty massive for, for what it was. So yeah, already done that one. So next one is here. So retail euphoria. So the story forming here was that energy's up, bonds down, can't lose. Again, we're just hopefully you're seeing the similarities of these, and you can see it very clearly in all of the media postings as well, or the social media chatter. Social media chatter is normally going to be much better to spot things that retail are saying than institutions and stuff like that, but both are important and both are useful at different stages. So the story here, energy up, bonds down, can't lose. Core fear, missing the obvious trade. What most believed, one-way bet, similar to crypto, similar to Nvidia and a billion others. The reality is that the story's getting crowded. The fresh news is moving price less, and Google searches peak energy hype everywhere. Now, despite that, you'll notice in the next stage with the exhaustion unwind, we still rocketed up. Why? Well, let's first of all go through this and I'll explain exactly why that is. So the story forming, maybe the Fed overdoes it, meaning maybe they're increasing their interest rates too quickly. That can lead to a recession. So for context, if you don't understand kind of the basics of how interest rates work, if you increase the cost of borrowing, that means that you're increasing the cost of credit for businesses to borrow, for consumers to borrow, which means that over time, it begins to restrict spending on a business level and on a consumer level, which makes the economy shrinking. Shrinking makes it shrink. And so therefore, the whole idea is why I said it was a balancing act earlier with these sorts of, with the interest rate and stuff like that, is because when you raise interest rates over time, the economy weakens. And so to avoid a recession, you need to eventually kind of ideally bring those interest rates down or find a way to strengthen the economy in another way during that time. And so that's why this fear began to creep in. Core fear is growth slowdown. Again, I kind of just touched on that, but if they're raising rates too quickly, people start going, oh shit, like this may cause an issue with like how quickly the economy is growing. And what most people believed, mixed and confused. This is again key because it's again that conflicting story starts to come in. It goes from like one-sided to suddenly like, oh, wait a second, maybe this isn't going to be that surefire thing that I thought it was. Next thing, reality. So inflation momentum cooled, focus shifted to growth. Signals, inflation month to month eased, commodities and yields rolled over. So this was a key sign because inflation was starting to ease a little bit, and therefore it's like, okay, great, like inflation is kind of controlled now, yet we're still kind of potentially raising rates. Like, how's this going to affect things? So there was a lot of conflict at this point. But going back to my point right over here, why did we go up during the exhaustion phase? Because you will find a lot of the time, whilst we've been going through some quite simple basic examples, that stories will overlap with one another. And the whole skill of this art is that it's about understanding when those stories cross over at one another and which one of them holds weight and in what scenario. So let's go over the top level. So top level over here is that the story forming on the interest rate side was keeping rates near zero, inflation looks temporary. So this is going to be very, very similar to what it was. Core fear here, hiking too early and hurting the recovery. In fact, you'll find that with pretty much this whole top layer, it's very, very similar. The reason and the place that I want to show the difference in mainly is over here. So where we saw over here, the exhaustion phase turned into, with this orange one, at least part of it, turned into a retail euphoria phase. Because here, the story was still higher for longer, with brief pivot hopes detour. And the core fear, yes, recession versus inflation, but most people still believe that more hikes are a one-way bet and briefly maybe a pivot, then back to hawkish. So the reality, markets whipsawed between softer Fed talk and a firm anti-inflation stance. And so what happened is, yes, when we went into exhaustion, we still saw like a little bit of that increase, but there was a lot of overlap between all of these. Essentially, we kind of knew that, well, at least everyone kind of knows that, okay, things are still rising. They're still looking to increase rates. That's still going to increase the cost of borrowing. Like, this market should still go up, but at what point will things begin to slow down? And so here's a classic example of it not being perfect, right? It's not perfect. It's never going to be perfect. But even if you were early, this is why I always prefer being earlier rather than later, as in line with the narrative, not just early as soon as I figure it out. Because you don't have to worry so much about the exit. It can get messy towards the end when stories begin changing. It's much better to kind of catch things here and be like, oh, wow, amazing. And then even if you got out here where you saw the exhaustion being, that's still probably like a 700% move from the base, right? Now, that's without leverage. So This is just an example. Things can get a bit messy. It's not going to be perfect. And actually spotting this and the nuance of this is why it's a little bit more complicated than it might first initially seem, in full transparency. But that doesn't mean it's impossible at all. In fact, I think it's really, there are loads of things you can do to stack the deck in your favor. So what's the essence of everything? So with all this in mind, we kind of have a rough overview of how narratives can move price. But in order for narratives to work, they are essentially helping us to align either with our prediction or away from our prediction to get out. And so why is that important? Well, we now need to understand, okay, well, how do I actually go ahead and make those predictions? How do I do that research? How do I find something before somebody else so that I can be one of those early adopters? And I've got an example video of me doing just that in the description box below, where I'm going over the AI robot, humanoid, whatever, movement from a macro and micro perspective that you might find useful. And by the time that you watch this video, I've probably got a couple more videos that I think will be relevant that I'll leave in the description box below. But until then, I really appreciate your time, and I'll see you in the next video. Also, if you've got any content ideas, let me know. I'm always open to hearing them. So thank you, and I'll see you soon.